All right, welcome to our 4:43 online session. Today is Monday, March 6th. This is the 12:30 p.m. section, and it is being recorded. Today, what I want to do, as I kind of mentioned in the announcement, is talk a little about the solution to homework 6 and do a little bit more practice on ROIC tree and CFI. And also, as we get started, talk about the upcoming midterm exam on Wednesday. So I'm going to actually start there. So Wednesday will be the midterm exam. You will take the exam during the time that you are registered for. So for example, since you're the 12:30 section, the exam will be available at 12:30. The exam will close 90 minutes later at 2 p.m. Okay, so if you're in the 11 a.m. section, you'll take the exam between 11 and 12:30. If you're in the 2 p.m. section, between 2 and 3:30. If you're in the 3:30 section, you take it between 3:30 and 5. Okay, so the exam will be a link called the midterm exam link. It'll become available during the time of your section. And again, the exam link goes away when your section ends 90 minutes later. So make sure that you submit by that time in the 90 minutes. So basically what the midterm exam is going to be is it's going to be an economic statement conversion. So when you get to the exam, you'll download an Excel file. It'll have an income statement and a balance sheet with all of the labels. And your job will be to convert that into 4 additional tabs: TII, TFI, CFI, economic profit. And those submitted balancing tabs, each tab is going to be worth 2.5 points out of 10. You'll basically submit, and that's going to be your grade. There's no write-up. There's just the working of the tabs. Very important that you submit in the Excel file that I give you. So I'm going to be very suspicious if you actually took the data and put it into some other Excel file. There's no reason to do that. So solvers are not allowed. So therefore you have to submit it in the file that you were given. Convert should be pretty straightforward in the process, and that'll be worth 10% of your semester grade. So questions about the midterm exam? All right. If you have an accommodation, and I've given you permission to take the alternative midterm exam, which will require a password. Basically, you've received an email confirmation from me that you'll take the alternative midterm exam, and generally that exam will be available the entire day on Wednesday. Same exam. The only difference is with people with accommodations are able to take it at different times than their scheduled sections. If they have the approved accommodation, they will take the alternative exam. So for the vast majority of you, you won't even click on that link. You'll just take the regular midterm exam. If you have the accommodation, don't click on the regular exam, click on the alternative midterm exam, take it within the time frame of your accommodation. Okay, so that's our goal for Wednesday's class. So you can take that exam anywhere. You don't have to physically be in Van Munching Hall. You could take it in your apartment. You could take it in the library, wherever you can get some peace and quiet for 90 minutes. It is an individual exam. You're not allowed to work in groups. And the only other thing I would just say about the exam is that it is kind of open book, open notes, and that you're going to have to use a computer. You're going to have to use Excel. You can use the previous assignment and the practice midterms as a guide while you're doing the exam, but that's it. Can't use anything else. Can't rely on anybody else to do the exam. It's an individual midterm exam. Okay. So again, final questions about the midterm? That's on Wednesday. Somebody's asking in the chat, they said, is the alternative link adjusted to account for extended time? It actually is not. So if you're taking the alternative exam, there's no timer on the alternative exam, different than the regular midterm. So it's up to you to basically submit whenever a time accommodation that you have if you're taking the alternative exam. Okay, so you'll know the beginning and the end of when you submitted, from the time you started the exam to the time you finished. Just make sure that that time you keep yourself and submit within that accommodated time. Okay. All right. Any other questions? A question? Either shout them out or say them in the chat. All right. So just again, since we are talking about logistics, so Wednesday, you will take the midterm exam. Monday, where homework 7 will also be due. So make sure you complete homework 7, which will be another ROIC tree and CFI write-up. We will have live classes next week, knock on wood. So no more Zooms. We'll be back in the classroom next week. So Monday, I'll see everybody all fresh-faced and ready to go, starting at 11 a.m. in Van Munching Hall, 3505. Okay, so Monday back in the classroom. Right. So the other thing I wanted to check in on is, I'm just logging into Bloomberg here, is to see how we're doing on the Bloomberg Trading Challenge. We are coming to the end of the first 6-week sprint of the Trading Challenge. And sorry, just trying to log into Bloomberg so I can share my screen. So I want to see how we're doing. And reminder of a couple things. One, stay in cash, or sorry, stay out of cash. Again, can't have more than $300,000 of cash at any time during the trading challenge. 2, remember you have to have at least 10 longs. Doesn't matter how many shorts you have to have at least 10 longs. And when we get to the end of the trading challenge for the first half of the semester, don't liquidate everything. Just keep your portfolio. And again, at 5 p.m. that day, I will score you against your peers. So just as a reminder, the Bloomberg Trading Challenge in the first half ends on Wednesday, March 15th. Okay. So again, that's the last day of the first half of the trading challenge right before spring break. So basically at 5 o'clock, I will go and take screenshots of all of the sections with the ranking, and I'll show you how we're doing today. And then basically based on that performance, the team in first place gets 5 points. The team in last place gets 1 point. So it'll be basically 5, 4, 4, 3, 2, 1 will be the distribution of grades for the sections. And then when you get back on Monday, March 27th from spring break, we'll reset the competition, and then you will basically do it again. Okay. Now, the other thing to remind yourself is that on Wednesday, March 15th, it is another mandatory attendance day because that is group case 2 presentation. That's going to be the historical presentation. And so what you're going to be presenting is the ROIC tree and CFI for Parker Hannafin, probably against one of its peers. And you're going to do that within 10 minutes verbally. Everything that needs to be in the presentation, including the screenshots, needs to be in that PowerPoint. And just like in the first presentation, you're going to be kept to time. So make sure that you go through everything in the 10 minutes and use numbers when you go through that presentation. So I will post probably in the next day or so all of the screenshots that you'll need to have the CFI and the ROIC tree for Parker Hannafin and probably one of its peers. And you will make that presentation again in class on Wednesday, March the 15th. Okay. Now going back to Bloomberg, just checking out the trading challenge. If I go to idea or team message, this is, I believe, section 201. One, no. 401. Here you are. All right, so again, what the rankings are going to be based on is portfolio value. Okay, again, I don't count. I'd be disqualified anyways for making one trade. So for this section, the good news is everybody has made the minimum 10 trades. So good job on that for the first half of the semester. And if the trading competition were to end today, this would be based on portfolio value from highest to lowest. How the rankings would run. So the team with M. Dorsey as the team leader would currently be in first place. They would get 5 points. Jay Lee and N. Blair would get 4 points. G. Nash 3, T. Gretsch 2, Arcone 1. That would be the distribution. But you can see these numbers are actually relatively close, particularly amongst these teams. So a lot can change in a week. But nonetheless, this is kind of how we stack up in this section of the trading challenge. And again, everybody's under the $300,000 cash available one. Any questions about the trading challenge? All right, well, while I'm here, since we're recording this, see how the other sections are doing. This is section 101. Again, I'll rank by portfolio value. Again, everybody in that section made the minimum 10 trades, which is great. That is the ranking. You'll be able to pause this on video if you want to look at this in more time. Section 401. Let's put them up there and where the 301 went. Again, this team in first place would be disqualified for not making enough trades. So they have to make at least 6 more trades in a week. So I know it's first place, but 4 doesn't count. Also, this team, and I know they're already in last place, but that's too much cash. You need to be out of cash by the end of the day. Right? The rule is 300,000 or less throughout the entire tournament. Now, I know you're already in last place. You're like, how would that hurt us even more? The answer is all the members of your team would get a 0. Nobody would be able to opt out of the final exam, and you'd lose any ability to do any extra credit in the class. So make the trades. I'll give you until the end of the day. That was section 401. And then finally, just quickly see if I can find 301. Portfolio value. All right. So here we have one team, same thing. They need to get to 10 trades by next week. They've only made 7 trades so far. Everybody is under the $300,000 threshold, which is good for available cash. This would be the ranking in section 301. Okay. So that's just kind of a quick view of where we stand. And you'll see, as I showed you all of the sections here in this video, that the market's been very tough. And in a choppy market, it's very, very difficult to make money, particularly when a lot of the tech stocks have continued to get pummeled. And I'm sure many of you have been investing in tech. So again, it's easy to make money when the market's going up. It's harder to make money when the market's going down. But nonetheless, we have to look for opportunities. Remember, we're still at the end of earnings season, and the best opportunity in the short term is when a company does something different than expectations. And that's a lot of what the challenge is about. Feel free to use your Bloomberg terminal to get a better understanding of that. All right, let's go through homework 6. File I gave you. Okay. So I gave you an ROIC tree and a CFI for Union Pacific Railroad. And I asked you to evaluate 5 years worth of data. So we'll start with Union Pacific's ROIC. Let me make this full screen. Just make it a little bit easier to see. Okay, so one of the things that you should have said is that Union Pacific's ROIC went from 12.4% in 2018 to 13.3% in 2022. Okay, now that would be sorry, admit somebody else to the class. That would be a 6.8% increase over the 5 years. But what's interesting is it actually dipped to 10.8% in 2020 before recovering in 2021 to 12.7, and then again, eventually hitting 13.3 in 2022. Now, the first driver is the tax rate. They paid the same tax rate in 2018 of 22.9% as they did in 2022 of 22.9%. Okay, so the tax rate was unchanged over the 5 years. So all of the 5-year improvement in ROIC was based on the underlying pre-tax ROIC, as it went from 16.1 to 17.2 over the 5-year period of time. And Union Pacific's tax rate has been pretty consistent of around 23%, high of 24% in 2019, but pretty consistent tax rate over the 5 years, right? So all of that improvement, including the dip and then the recovery from 2020 to 2022, was pre-tax. That's what's been driving their business. Now, as we look at the second driver, one of the drivers of pre-tax ROIC is margin. And you can see that the operating margin at Union Pacific went from 37.3% in 2018 to 39.9 cents per dollar in 2022. So their margins improved. Matter of fact, they peaked in 2021 at 42.8% before falling slightly in 2022. Part of that had to do with COVID. So basically, as shipping became somewhat disrupted by other parts of the supply chain and people were trying to ship more and more goods, they benefited by higher prices. That helped them increase their margin to 40.1 and 42.8 as an operating margin versus 2018's 37.3. Okay, 2022 was a little bit more year of inflation. And so the costs started to rise. And that actually led to a slight decline in their operating margin to 39.9. Okay. Now, as we look at the third driver, we can look at productivity. Invested capital to sales started at $2.31 and it finished at $2.32. So pretty flat, went up slightly, but basically similar productivity in 2022 to 2018. Okay. Now, what's interesting is it got worse in 2020 as basically the network got a little bit less efficient in 2020 because they were spending $2.85 on invested capital sales before recovering to $2.31 in 2022. So there's a little bit of a Boeing effect. They were getting higher margins in COVID, but a little less volume, let's just say, on their network. And that was kind of offsetting each other. But net, that's why their operating ROIC fell to 14% in 2020. Right? Now, as we look at the second level drivers, why did the operating margin improve by 7% over the 5 years? Well, again, it's hard to look at gross margin in this industry because of the way that they break things out. So the real driver here is SG&A. In fact, in the railroad industry, SG&A as a percentage of sales is called the operating ratio. And all the railroads are measured by the finance community on how low can that number be? Because it's basically, they don't spend a lot on R&D. They don't spend a lot on marketing and branding. Their spending is really on the cost of running the railroad. So operating ratio as low as possible is a key driver and metric for Union Pacific and the other railroads. So in this case, 62.7%, 2018 SG&A, 60% SG&A in 2022. Okay. Now you also see their depreciation got more favorable, spending 9.6 cents per dollar in 2018, 9 cents per dollar in 2022. Right. But a lot of the drop in the SG&A led to an increase in the operating margin. Okay. And that was the dot that we want to connect. So somebody says, we can't see my screen. Is that true? Has that been talking? Can you see my screen? Can you see my screen now? Can I get a verbal yes or no?
Yes, we can.
Okay. Have you been able to see my screen the whole time, or has it been not available?
No, we haven't seen it.
Sorry about that, but you can see it now.
Yes, we can.
Okay. Yeah, if I'm talking and the screen's not moving, please let me know because I'm looking at the screen. I'm assuming it says sharing, but I'll make sure you guys can see what I'm doing. So what I was showing you very quickly, couple numbers here. ROIC 12.4 to 13.3, tax rate flat 22.9 to 22.9, pre-tax ROIC 16 to 17, although it dipped to 14 before going to 17. Operating margin 37 to essentially almost 40. Okay. And again, it was the SG&A. This is what's called the operating ratio, key driver, 67 to 60. And depreciation got about 1 penny better, 9.6 to 9, right? But gross margin fell a little bit, $1.96 to $1.90. So really it was this drop in what's called the operating ratio, the drop in SG&A as a percentage of sales was the primary reason the operating margin went. Okay. And that's where I left off. Thanks for letting me know that you couldn't see my screen. All right. So now looking at the drivers of productivity for Union Pacific, 231 to 232. Okay. Did anything really change, even though it stayed flat, invested capital to sales? Remember, it peaked at 285 in 2020 before recovering. So first, working capital went from slightly positive, essentially 1 cent positive, rounding off, to slightly negative. So less working capital, going from positive to negative, less working capital. That was a slight improvement in their business. Remember, working capital is primarily accounts receivable plus inventory minus payables, the primary drivers. Now, PP&E as a percentage of sales, this is basically their network and rail cars. $2.31 of spending in 2018, $2.32 in 2022. So basically a little bit more spending on the network, a little bit more efficiency on working capital, but net, this 0.04 cents of worsening was probably due to spending here on the network, right? And again, back to 2020, they seemed to spend more relative to sales. That was during the time of COVID. So that probably suggests a little bit of a sales drop, okay? But basically flat productivity, right? An improved operating ratio, SG&A as a percentage of sales going from 62.7 to 60.1 led to a slight increase in operating margin from about 3 cents from 37 to about 40. That was the primary driver of the pre-tax ROIC going from 16 to 17. Flat tax rate led to the after-tax ROIC going from 12.4 to 13.3. Okay. So that's kind of the walkthrough. We start from the left, we move to the right, cover all 3 first level drivers. Then we go back and loop around. What are the drivers of operating margin? What are the drivers of invested capital sales? Those are the second level drivers. Once we've gone through those, summarize any key ones from the second level that lead back to the first level, that lead back to the changes in the ROIC. That's the walkthrough, and that's the process that I'm going to want you guys to follow. Again, I'll pause. Questions about any of this? Now, you'll also notice that I sprinkled in a few comments about what was happening with Union Pacific. Somebody's asking me in the chat, do we need to explain level 2 drivers of productivity if productivity is not a key driver of ROIC? I think the question is the answer, meaning if the level 2 drivers, which in the case of Union Pacific, didn't really change that much. Because if you kind of look at these numbers, I mean, we're talking about some very minimal changes, then that's what you can say, is that, look, the working capital didn't really change that much. The PP&E to sales didn't really change that much. So therefore, the invested capital didn't change as much. Like, that's okay to say. And that's the way to address that. So if it's not changing, then explain it's not changing because the numbers aren't changing. Because sometimes we might see a not changing operating margin, but when you get down to the income statement, for example, we saw a big change to the gross margin and a big change to the SG&A. So maybe something is changing about the business and it's just netting out. Or they're staying flat and neither one are changing, and that's why it's not changing. Those are important insights when you're actually walking through the numbers. Now, the other thing that you should be doing at this point, whether it's your homework 7 or whether it's your group projects, when you have 7 or 8 people working on these group projects. And this is where EIC can start to help you. Go back to Bloomberg. So if I go to Union Pacific, then BICO. Read through the BICO, because that's going to give you some additional insight as to why some of these numbers are changing. Okay, remember that BICO is the Bloomberg intelligence on a company. It's the summary of what the analysts are saying. So your cliff notes for the analysts. Right? And secondly, you can also see that you can look at the analyst reports themselves and BRC. And another area that you might want to consider is EVT, which is the event calendar. And when a company reports earnings, all the earnings calls are going to be listed here. Like this was their fourth quarter earnings call, which would have been essentially the 2022 results, which was released on January 24th. And if you click on these little icons, this icon will actually load from the earnings call a transcript. So as the company is delivering its earnings call where the analysts were asking questions, Bloomberg is listening to that call and using technology to transcribe it in real time. And so this is the transcript of that earnings call and all of the questions that the analysts were asking and the answers that management was giving. So again, it's going to be pretty insightful as to they're explaining in the earnings calls why their numbers are changing, because that's what the analysts want to know as well as the future of the business. But nonetheless, another important insight. So back to when you're giving these numbers, it's important to understand what company you're talking about and the context of what these numbers are telling you. It's not just a quantitative reading of higher, lower, same, higher. Like that's not enough, right? And so it's almost what's the number, what's causing that change in the number at a high level, any context for those changes. That's what I want you to start practicing on. That's what will differentiate you as a better analyst. And that's what I'm going to be looking for when we do Parker Hannifin, because if nothing else for Parker Hannifin, you've already done an EIC and you spent a good amount of time better understanding the company. You should be applying that knowledge when we go through this historical analysis. All right, that was the ROIC tree. Questions about the ROIC tree? Okay, so I am sharing a second time. And I hope you can see my PowerPoint because I'm going to the CFI. So just as a confirmation, can you see my CFI on the screen?
Yes, we can.
Okay. Wonders of technology. All right. So basically, as I told you, when you guys start with the CFI, where you're going to start with your analysis, it's right here with free cash flow, right? Because the whole point is over 5 years, Union Pacific generated $27.8 billion worth of free cash flow. Okay. So as I said, if you have positive free cash flow, a lot of the analysis for the other 3 sections is going to be, where did that money go? Okay. If the cash flow is negative, where did the money come from? Okay. So that's going to frame how we do the analysis. So the first thing is, how do they generate 27.8 billion of free cash flow? At a very high level, they generated $45 billion of gross cash flow. They invested into their core business $17.2 billion, which led to, that's a typo there, probably an average reinvestment rate under probably around 35-40%. If it's 17 divided by 45, call it 40%. That's a typo there. leaving them $27.8 billion of free cash flow after goodwill. And again, no investments in goodwill and intangibles, so no acquisitions by the railroad. Now, the other thing is their ratio of CapEx to depreciation, another typo, for some reason that didn't get carried through, but generally 140%, 149%, 238, 102, 140, 147. They've been spending. For 4 of the 5 years, they spent more than depreciation. And in 2022, they spent 147% of depreciation. It translates to about $800 million a year of actual CapEx. But that's the point. They are spending with the assumption that there's going to be some growth in their rail network. And they're signaling that 2023 should have a little bit of growth. And you can see that those improvements of gross margin took their NOPLAT, which was $6.5 billion in 2018, up to $7.7 billion in 2022. And despite the dip to $6 billion during COVID in 2020, it recovered pretty well. It is now much higher than it was in 2018. Okay. Now, when we look at their gross investment, almost all of it is in capital expenditures, right? Not a lot of change in working capital, right? But they're spending anywhere from $2 to $5 billion a year every year in capital expenditures, much higher than their depreciation rates. Okay? Now, that's what led to the $27.8 billion worth of free cash flow. If we look at the cash flow available to investors, that grew to $30 billion. That means they generated essentially $2.2 billion in non-operating cash. Where did the $2.2 billion come from? Well, $974 million came from a non-operating gains, which they have pretty much every year, of anywhere from $160 million in 2019 to as high as $328.6 million in 2022. Okay. They also had $776 million generated by a change in their non-operating assets and liabilities. And finally, they also saw a decrease in their excess cash of $418.7 million. Although in 2020, that actually added to their cash, but in the other 4 years, they've been drawing down their excess cash reserves. So when you add those up, that's how you get to the $30 billion worth of CFI. Okay. How do they then distribute this to the debt and the equity holders? $4.2 billion of after-tax interest expense, negative $18 billion worth of debt. So you can see that they were consistently borrowing debt every single year, right? And given that they had positive free cash flow in every single year, we know they didn't really need this debt. So it's a clue of where this debt might have been used. As we go down, they paid out $13.4 billion worth of dividends, but they also repurchased $31 billion worth of stock. So essentially 45, if you add and round off, $1 billion worth of payout to shareholders, much higher than their $28 billion worth of free cash flow. So that $18 billion of increase in debt was primarily used to repurchase the stock. Okay. And that would be our story of Union Pacific. Questions about Union Pacific, their CFI, anything I went over? All right, since there's no questions, here's what we're going to do. I just want to do a quick example of another company. And this one, I'll just let you know, is a little bit more challenging because of COVID. And we're going to look at Royal Caribbean Cruise Lines, right? So I'm going to put into the chat the file. It's going to be called rcl.powerpoint. I'm also going to put it in the files folder. And I'm going to put you into some random breakout groups for 10 minutes, give you a chance to kind of walk through the CFI and ROIC tree in your breakout groups, pull you back, and then we're going to talk about it. Okay, so just one more practice with Royal Caribbean. So get it in the chat, also about to put it in the files folder. You have one person share, they can share their screen while you're in the breakout rooms. And then we'll see everybody back here in 10 minutes. All right, welcome back. Hopefully you guys had some good conversations about Royal Caribbean. Does anybody want to volunteer to start us off? I'm going to try and share my screen again. Talking about the first level drivers of ROIC. Well, since we're online, I'm not going to painfully start to call on people. So I'll keep doing it myself. But to be honest with you, it's better if you guys practice. Just rather get feedback, right or wrong, now than see a terrible presentation grade in a week and a half. But regardless, what you should be talking about, again, let me make sure my screen is sharing in full. And hopefully it is, you're able to see this full screen. If you can't see the file, let me know. But basically, the first thing you're going to notice is that Royal Caribbean doesn't pay any taxes. So they and Carnival have set up their jurisdictions, so they are basically tax-free, even though they're for-profit companies. So their after-tax ROIC equals their pre-tax ROIC. And you can see that pre-pandemic, their ROIC was around 10%. In the middle of the pandemic, it fell to negative 16.7%. So essentially 10 to 9 to 9 to negative 19, negative 17. So it really hurt during COVID in 2020 and 2021. Now, why'd that pre-tax ROIC fall from 10 to negative 17? Well, you can see their operating margins went from positive 20% in 2017 to very negative in 2020 and 2021. Okay. And what ended up happening is their sales went down by like 80%. So costs were somewhat fixed. So basically their SG&A, for example, as a percentage of sales looked sick, mainly because their sales had fallen off the cliff. But basically they went from making about 20 cents per dollar to losing almost $2 for every sale. And that really hurt them. At the same time, from a productivity standpoint, pre-pandemic, they were spending about $2 of invested capital to generate $1 of sales. 2017, it was $1.97. 2018, it was $2.24. By 2021, they're spending $15 of invested capital to generate $1 of sales. Now, the point here is that this wasn't because they were spending a lot on ships. This was because revenue plummeted. So same investment, a lot lower revenue, invested capital sales looks worse. So I mentioned this before, and I'll highlight this again. The story in this case of Royal Caribbean and the worsened productivity wasn't because they spent a lot of stuff that nobody used. It's because basically nobody showed up for the stuff they already had. And that made their productivity look worse. But regardless, the worsening of the productivity and the losing of money combined to drive their pre-tax ROIC to negative 16.7%. Right? Now, when we look at what was behind that worsening productivity, we can see that working capital went from negative 30 cents to negative $2.64. So if nothing else, they got really good at slow paying their vendors while they were in financial crisis. Now, PP&E to sales went up dramatically from $2.24 to $17.26, again, because many of their ships were 20% full in the middle of the pandemic. Very few people were cruising because cruising, if you remember, is where COVID kind of started, where it got really bad. It was that ship that couldn't dock in the US for a while. Nobody wanted to let it dock anywhere. And a lot of people were getting affected on the cruise ships, just a petri dish. So that really hurt them in particular, and you can see how their productivity worsened as a result. Now, intangible to sales went from 3 cents to 53. Again, not because they were buying a lot of companies, but because the revenue plummeted so much relative to the fixed cost intangibles that they did have historically. So again, I just want to draw that distinction as we would be walking through Royal Caribbean. Okay? And same thing with depreciation. Depreciation of sales spiked from 11 cents per dollar to 84 cents per dollar. Again, SG&A went from 69 cents per dollar to $3.34 per dollar. Slightly higher gross margin, but the point is the cost to operate the ships, the amount of depreciation, those spiked, which plummeted their operating margin. And so 2020, 2021, high fixed costs, lost a bunch of revenue. They lost a lot of money. So you can clearly see that it was the drop in revenue, which is not directly correlated to this chart. You don't see the percentage change on here of revenue, but you can see the percentages of cost as a percentage of revenue spike dramatically because of that drop in revenue. And that was the catalyst for their operating margin falling from 20 to negative $2.53 per passenger, which also led to the pre-tax ROIC falling from 10 to negative 17. This one's messy. Okay. Good news for you, Parker Hannafin, is it won't be messy. But even when it's messy, we still have to try and explain what's going on. And you'll notice I'm throwing some catalysts out there to why the numbers are changing. A little bit of context when you give the numbers, very, very useful. If we look at their CFI, we see kind of a similar ugly story. 2017 to 2021 total CFI, negative $7.9 billion of free cash flow. Their free cash flow is negative 3 out of the 4 years, although for different reasons. In 2018, the free cash flow was negative $2 billion. Why? Because they had $2.9 billion of gross cash flow, but their gross investment was $3.9 billion, including $4.7 billion of CapEx. They were spending very heavily on the ships, 461% CapEx to depreciation ratio. Royal Caribbean was building even bigger, more expensive, more luxurious ships. And these ships cost a lot of money. And as they were putting them into place, lots of money was being spent on CapEx, more than 100% investment rate. In COVID, situation shifted. The CapEx plummeted. 2020, they only spent $971 million on CapEx, but they started losing money in the income statement. They had negative $3.3 billion of gross cash flow, which led to negative $5 billion of free cash flow. So the point is, 2018 and 2020 both had negative free cash flows, but for far different reasons. One was because they were spending when they were making a lot of money with blue skies ahead, blue seas, fair ocean ahead. The other was skies got very thunderstorm hurricane because of COVID and basically started losing a lot of money. So even though they slashed their spending, the free cash flow went negative because of the losses. So again, that's what's different about 2020 and 2021's negative free cash flows. But overall, negative $7.9 billion of free cash flow over that 5-year period of time. Gross cash flow, $3 billion over the 5 years. But again, the final 2 years, negative $3.3 billion and negative $2.6 billion. So all of that gross cash flow was earned in the first 3 years. Gross investment of $10.4 billion. Again, most of that investment occurred in 2018 and 2019. That was 4 and call it 5. That was $9 billion of the $12 billion rounding off of CapEx was in 2018 and 2019. Okay. The investment rates plummeted in 20 and 21 compared to the previous years. Again, time of COVID, they weren't spending nearly as much. They were still spending something. Now, how did they fund the negative $7.8 billion worth of free cash flow? Okay. Didn't make a lot of acquisitions, right? $521 million increase in goodwill over the 5 years. They did buy somebody in 2018, $1 billion of goodwill. What did they do to fund the 7.9 billion? Well, 7.9 billion of negative free cash flow became 11 billion of negative CFI. The big change there, two things. One, they did increase their excess cash by $2.7 billion. So in 2020, as sales were plummeting, they did take some cash and they basically hoarded it and started to create a little bit of a rainy day fund in the bank. Okay. Started drawing down some of that excess cash in 2021, 969 million, but they did put a lot of excess cash, almost all of it in 2020 was that increase in excess cash, 2.7 billion net over the 5 years. They also increased their spending in non-operating assets. Okay, so as they bought more non-operating assets, that also chewed up $400 million worth of cash. Net effect, taking 7.8 billion of free cash flow that was negative to 11 billion that was negative CFI. How did they fund that? Well, they had to pay out $3 billion worth of interest expense over the 5 years. That wasn't funding it. They borrowed $12 billion worth of debt. Now, interestingly, they paid out $1.9 billion worth of dividends, although no dividends in 2021. They suspended it and cut it in half in 2020 from the previous levels. They also, if you look at share repurchase, they stopped basically buying back stock in 2020 and 2021. So a lot of that debt increase, 8.6 billion in 2020, 1.7 billion in 2021, that was to fund the losses. Okay, so they were funding the negative operating performance of the business. Unlike Union Pacific, which was borrowing even during COVID to buy back stock. Different story here at Royal Caribbean, because the business was on its heels because of that tremendous drop in passenger volume. This, if we had done an EIC, is an industry very, very sensitive to economic changes, and particularly the health changes in the market. The macro economy really affected travel. Okay, and so essentially their borrowing had more to do with needing to do it to survive rather than, and to get through the COVID period, rather than fund an expansion or fund basically a shareholder repurchase. Okay, so a little bit of difference here in their CFI than some of the other CFIs that we looked at, but somewhat consistent with the ROIC tree and the story we saw about the deteriorating performance. All right, questions about Royal Caribbean? Did you guys talk about anything else in your rooms? Did you want to point out anything? Ask about anything? These are some of the things that, as I said, when you're going to be presenting verbally in a week and a half, your analysis of Parker Hannifin that I expect you to link back to, as I said, you've done the EIC. So here's the number. Why did it change? How does it affect the ROIC? How does it affect the CFI? And more importantly, why? What are some of the context behind that's happening? So you're gonna have another homework 7. I'll post that sometime tomorrow. It'll be due on Monday. Another practice, walking through the tree, walking through the CFI for this version of the assignment, individual, but I do expect in the next write-up a little bit more context beyond the numbers. So in the first one, I said, look, you're just learning the structure of how these statements work. It's okay to focus on the numbers. The next one, I want to see some context and preparing you for your group project presentation. So I'll also put up in the next day or so the Parker Hannifin's numbers so that you can start working on that as a team. All right, so that covers what I was hoping to accomplish today. Again, final questions about anything? So take the midterm on Wednesday during your class time. Make sure you complete homework 7 by Monday. We will see each other face-to-face in class for all 4 sections on Monday. That's the plan. And again, start working with your teams on Parker Hannifin this week, because a week from Wednesday, I believe it is, whenever it is, right before spring break, 2 weeks, I have to go back and look on the syllabus. That group project presentation is coming up pretty quickly. All right. Good luck, everybody. See you guys on Monday. And again, I'll post this video later today.